Hello, everyone. Nice to see you again. And tell me, please, can you hear me? Can you see me? Could you write me in the chat? Could you see my screen? Okay. Hello everyone again. Nice to see you. And today we will work with topic quantitative analysis. We will talk about the quantitative analysis in budgeting. We will analyze different methods, uh, such as high-low method for analyzing fixed costs and variable costs, learning curves methods, expected values, and variance analysis. During my lecture, we are going to look through some examples, some quantitative examples of these methods applications. And finally, our final part will be dedicated to the speech of Gary Cookins. We are going to listen to part of his speech about the application of performance management tools, about the practice of performance management. And you will watch this video and you will answer the questions. It will be individual work for feedback, after lecture feedback. So let's start our lecture today. We will start talking about the high-low methods, why and when we use it. Mostly we use it when we have data that consists of mixed cost, and in order to identify variable and fixed components in these mixed costs, we use the high-low method. So we use it to determine the fixed and variable components of mixed cost. On my slide, you can see the high-low method formula, and we use a two-steps approach. First step is to identify variable cost per unit, and second step is identification of fixed cost. Regarding the variable cost per unit, we use the relation between the difference between the highest activity cost and lowest activity cost, and two highest activity units minus lowest activity units. And our fixed cost we can identify by two approach. First one, you can see the first one approach on my slide, and second one implies that we use instead of highest activity cost and highest activity units, lowest activity costs and lowest activity units. And now looking through the example, you will understand how could we apply these methods. So let's look at my slide. Let's look at the example. This example is about the company, Western company. And we can see the figures connected with units produced per month and mixed cost for first 6 months of the 2019. And our task is to determine the estimated variable cost rate and calculate fixed cost using high-low method. So we are going to apply the high-low method. At the bottom of my screen, you can see the formula. and you can see the figures. And we should apply properly the figures. So what is the highest activity cost? Highest activity cost, we have the highest activity cost in May. In this month we had the highest quantity of units produced and highest mixed cost. Regarding the lowest activity cost, we can talk about the January, when we had the minimum units produced and minimum mixed cost. Using the variable cost per unit, using these figures, we can get 1.5 per unit in dollars. It is variable cost rate. Based on this variable cost rate, we can calculate the variable cost using our figures of highest activity level in May and lowest activity level in January. We should multiply the quantity produced in May and in quantity produced in January in units by variable cost rate. And this way we can get two figures for variable cost. As for fixed cost, we can use the following methods. So we can use the formula. You can see this formula at the bottom of my screen. Our task is to identify the difference between the highest activity cost and the expressions variable cost per unit multiplied by the highest activity units. And in this way we can identify the fixed cost. So as you remember, the fixed cost is the constant figure, so we are getting the same result for May and for January. So we applied this formula, two formulas for variable cost per unit and for fixed cost, and we are getting the results, and we made all required actions. On our tutorials, we can try to use these high-low methods in order to solve additional cases, in order you can train this technique. The next one, some words about the limitations of these methods. Of course, we should talk about some problems or some limitations, and these are the following. This method, so this approach ignores all cost information, so we can use only current information about the mixed cost, and then we are getting the results that allow us to identify the fixed and variable cost. This method is so-called very simple method. So and we use approximate values connected with cost estimation. And regarding the estimation, our estimation is based on the historical information, but the data may have changed, the situation may has changed, so this is also the limitation of this high-low method application. The next method is called learning curve. Learning curve, or you can see the Russian synonym. This is interesting tool, but also this tool has its own limitations. As you see on my slide, I explained you in some words about the idea of this tool. It is an analytical tool, analytical method. The aim of these methods is to quantify the rate at which cumulative experience of labor hours or cost allows an enterprise to reduce the amount of resources it must use in manufacturing. Some words about the idea of this approach. Idea is based on our intuition, so we are learning by doing something. We often experience this effect or methods when, for example, we take a new sport or start to use keyboard, and our skill levels increase rapidly with our practice, and it means that we are learning by doing something. But then our progress is starting to slowing down. So when we use this learning curve methods, we use it to predict how long will it take to complete a future task. So how long we can complete a task, we can manufacture, for example, some products with a certain efficiency. Or we can use this method to calculate the marginal cost of making extra units of products. Also, we can use it for preparing the budget. Some words about the limitations of these methods. If we are talking about the idea, learning by doing, so I mean, if we are talking about the rapid growth of our skills, or rapid growth of efficiency in production, this situation is not always exist in terms of sectors of industrial sectors. So not each industrial sector can illustrate or can have this phenomenon, because learning of the idea assumes stable conditions. So of course everyone understand that it's not possible, because we have the labor turnover, and some other factors can be changed due to some external or internal environment. And also, the third limitation is the following: it must also assume a certain degree of motivation among employees. And a little bit later, um, analyzing my example, we will understand what we mean. Let's look at this chart, and let's look at the main conditions for the learning effect. For this learning effect, we mean the rapid growth in skills, um, uh, the most important condition is necessary for the process to be a repetitive one. Of course, we understand that this condition implies that we deal with traditional manufacturing, and only traditional manufacturing has processes that are repetitive one. And the second condition for the learning effect is the following: there needs to be a continuity of workers. So it means that they mustn't be taken prolonged breaks during the production process. And of course, it is a complicated condition. So these are limitations for learning curve application too. Then let's look at the learning curve formula. Y is the cumulative average time per unit to produce X units. A are the time taken for the first unit of output. X cumulative number of units produced. B index of learning. We can calculate this index by using the logarithm. And our learning rate, the measuring of learning rate. So we use this abbreviation for the learning rate. And let's look at my example. I use the tabular approach, my example, and we use this tabular approach. We can use this tabular approach only when we are talking about the cumulative. We use the cumulative output that doubles. It doubles. And we use the following logic. Every time that cumulative output doubles, the average production time is equals X% of what it was before. And X% is the learning rate. And let's look at the example. My case is about the platinum company. And this company operates, uses standard costing system. We know the standard labor time per batch for new product. It equals 200 hours. And using these standards, The resource allocation and cost data were prepared on this basis. Then we have the required questions. And what are required? Calculate the monthly learning rate and identify when the learning period ended. And we are also required to discuss the implications of this situation for the platinum company. Let's look at the data. We can see the number of batches produced each month. And we can see the figures for labor hours taken to produce the batches. On my next slide, you can see in the first three columns the same information. And then our fourth column demonstrates us the number of batches as cumulative number. So what is cumulative number? It means that it is the sum. For example, for June, it is one batch. For July, two batches, because we have to sum up the number of batches produced in the current month and in the previous month. And doing in this way, we can get the cumulative number of batches. The same situation with the cumulative total hours. Using the column 3, incremental total hours, we can calculate the cumulative total hours using the figures for previous month and for current month, and calculating the sum. And cumulative average hours per month per batch. We can calculate these figures, and you will see the result in the last column. Learning rate. We can calculate the learning rate by using relation between our cumulative average hour per batch in previous month and in current month. And our calculations, our results demonstrate that the learning rate is the same. Monthly rate of learning was 88%. 88%. But looking at our table with the results of our calculations, we can see that the learning period ended at the end of September. So we can answer our question about the period of learning. The learning period ended at the end of September. And what does it mean? It means that beginning from October, starting from October, the time taken for producing each batch of the product was constant. The platinum company could try to improve its production process by using the following actions. So, as you remember, we are required to explain explain the situation and to analyze how could we improve the situation, and we can improve the production process. And what should we do? For example, we can increase the level of staff training provided, so we could improve the qualification of our staff, or we could motivate staff to work harder. For example, applying the system of material simulation, for example. So we applied this approach, we applied the tabular approach, we applied the learning curve methods, and on our tutorials we also try to use these methods for cases. The next one is expected value. Expected value, I think that these methods you know this method well, because we use it in different forms in investment analysis, in scenario methods, in scenario method and sensitivity methods. My next slide illustrates the example when we use different scenarios of profit. We use the probability and different figures for profit corresponding with the scenarios and with the probability, and we are getting the expected profit and the sum of expected profits per scenarios allow us to get the expected value of profits. My next slide, on my next slide, you can see the example, and I ask you to try to solve this mini case. We can see scenarios, 4 scenarios, and income corresponding with these scenarios, and we can see the scenarios and targets for income for project A and project B. We also know the probability of each scenario and what is required to calculate the income expected per each scenario for project A and project B, and to calculate the expected value. And I give you some time, and please calculate. I give you 5-6 minutes to calculate, because it's very simple case. And please write me in the chat your results, and we check together how do you understand, how do you apply this expected value methods. So I give you 5 minutes in order you could apply these methods. And please write me in the chat your result for expected value for project A and project B. So when you are ready, please only write 2 figures: expected value for project A, expected value for project B. For A, correct answer, thank you. And for B, and I'm waiting for your results for B project. Have you calculated expected value for B? If you have calculated and if you have got the result, please write me in the chat and we okay. Okay, thank you. You're right. So correct figures. And if our task will be to compare and to choose this project and choose one of this project, what project would you prefer? Project A and project B, if we use only these expected values? Of course, B. Thank you very much. Thank you. And the last method for today to discuss is variance analysis. And we have started to work with these methods on our tutorials, and we continue working on our next tutorials with these methods. Our task is to look through this logic, and on our tutorials we will work in details with this variance analysis approach. So on my chart you can see the base for our discussion. Our profit depends on manufacturing costs and sales, and our manufacturing costs consist of material, labor, overhead costs. So material and labor costs are the base for prime costs, and using the following case, let's try to understand the factors that influence the variance in budgeting, variance in costs. So let's imagine that our company set a target to make a profit of an amount of 100 million, and our company is going to sell goods worth 200 million, and the total production cost is going to be 100 million. But at the end of the year, the company got the results. The profit is 50 million instead of 100 million. And of course, it's not a good fit for enterprise. And there are certain factors that affect the profit of the company. One of the factors, the production cost changes from 100 million to 120 million. And production cost changes due to some factors: change in material cost, change in labor cost, change in overhead cost. The main idea of the variance analysis is to identify the variance. Variance is the difference between the actual result and the target result. So the actual output and the standard output. We can talk about the different types of variances. We can identify controllable and uncontrollable variances. If we are talking about the controllable, we imply that we can control this variance by taking some actions. Uncontrollable variance means that this variance is beyond the control of the chief of the department head. So that's the logic. And we can talk about the different type of variances corresponding with the different factors that can cause these differences. We can talk about the material variance analysis, labor variance analysis, overhead variance analysis, and sales variance analysis. So mostly these are 4 types of variance analysis, and we can use these 4 types in our practice. What does it mean, materials variance analysis? It means that this situation, we can have the situation if we pay too much, then the purchasing cost increases. Also, if we use too many materials, production costs increase also. Third situation, both purchasing and production costs are dependent on each other. So we have to look into not only the purchasing costs, but also the production costs to know the total variance as well. So this are main, this is the main situations that may cause their material variance. And let's look at the example. We use 2 material types, A and B. We know the standard price, actual quantity, and standard quantity, and the total amount, total quantity. Regarding the cost variance, we can get the cost variance by calculating the difference between the standard cost and actual cost. So in order to get the result of cost variance, we should calculate the total cost by using the standard costs and actual costs, and to calculate the difference. And we can see that the impact of the variance of cost of material is due to price and quantity. Is due to price and quantity. When we are talking about the variances, we can identify favorable or unfavorable variances. Favorable, we are talking about the favorable variance when our budget or when our actual results are better than budget result or target result. And we are talking about the unfavorable variance when our actual results are worse than budget or planned results. On my next slide, we can calculate the impact of price on material variance analysis. In order to calculate the impact of price, we should calculate the difference between the prices, and we should multiply this difference by the quantity of product material A. The same way we use in order to calculate the impact of price on material B. And we can use the classification, and we can identify the favorable or adverse or unfavorable or the variance is. And our result is adverse. So the impact is adverse and variance is adverse or unfavorable. The same logic we can use in order to identify the impact of quantity on material variance. We can calculate the difference between the actual and standard quantity in material type A and material type B, and we should multiply this difference by price. And in this way, we can calculate the impact of quantity on cost variance. And our analysis illustrates that we have adverse variance, and we can explain this situation. So we can explain this situation occurs due to the use of inferior material or excess material, whereas mix is due to using a combination of two materials in different proportions during the production process. So when we use different proportions or mix, of course, we can have this material. We can have this material variance due to this mix. On my next slide, you can see the main reasons for labor variance. So it is the second type of variance. Different reasons we can have for labor variance. For example, change in design and quality standard, low motivation, over time. And in my example, I illustrate you that if we have the following figures: standard actual output for skilled, semi-skilled, unskilled workers. And if we have the figures for hours used in our works, and if we know the figures for production, on my slide you can see the current figures, the main figures of our case, using the logic for labor variance. We can calculate the labor variance. So we can calculate the actual time for skilled worker, the standard time for skilled worker, using our figures. And using the following logic, we can use the direct labor cost variance. In order to calculate the direct labor cost variance, we should calculate the difference between the expressions standard time multiplied by standard rate and actual time multiplied by actual rate. Standard rate and actual rate, we know these figures. These figures are in our conditions. And standard time and actual time we have calculated on our previous step. And using this logic, we are getting the variance, direct labor cost variance. And we can see that these variances are adverse, unfavorable. So we have got unfavorable results. Then, using our example, we can identify direct labor efficiency variance. We should use the following logic. Standard rate, we should multiply by the difference between the standard time and actual time. And using this logic, we are getting the variances for different types of workforce, for skilled, unskilled, semi-skilled. And we are getting the following results. Favorable variances for two types of workforce, and the third variance is unfavorable or adverse. Also, we can use the overhead variance analysis, and on my slide you can see the main cause of this overhead variance. And the main reasons for overhead analysis, the main reasons for overhead variances, for example, labor use, inflation, lack of planning, lack of cost control. And using the following figures, if we have the actual figures for quantity, hours, and budget figures for quantity, hours, and units produced in figure in units produced, we can use the overhead variance analysis. We can use the following logic. So we should identify hours rate based on the actual hours and based on the standard hours. And we should identify the variance. And based on my example, we have got the favorable result. And sales variance analysis, we use the following logic. We are getting the sales value variance when we use the difference between the budgeted sales and actual sales. And also we can identify what factors are the main in this type of variance. We can identify the sales price variance and the sales volume variance. In order to identify sales price variance, we can multiply actual quantity by the difference between the actual price and budgeted price. And in order to identify sales volume variance, we should multiply budgeted price by difference between the actual quantity and budgeted quantity. And also we use this logic on our tutorial in order to, on our next tutorial, in order to train this um, sales variance analysis in practice. And also on my slide, you can see the reasons for sales variance. So change in price, change in market size, change in customer behavior, for example. And in the end of my presentation, you can see the next slide for standard costing. I can use these slides in order to give the brief explanation for term of standard cost. And on our next lecture and on our next tutorials, we are going to get in details in standard cost analysis in order to understand how to apply this analysis. In general, we use the standard costing system in order to establish some norms for use of materials, use of expenditures. So it helps us to regulate our expenditures, to establish some targets in our budgeting process. So we may conclude that it's very useful. It's a very useful tool in cost budgeting. And now we are moved to our final part of our lecture. And our final part will be dedicated to the speech of Gary, expert in performance management, Gary Cookins. You remember that some days ago we have listened to his speech about what project management is, and today we are going to listen to Gary Cookins' speech, the part of his speech, and your task will be to listen to parts. I wrote you the period in minutes for part 1 and for part 2. And in part 1, please pay attention to the role of business intelligence and business analytics in enterprise performance management, and try to describe in 1 or 2 sentences what is the main role of business intelligence and business analytics in enterprise performance management. And the second one, question for you: do you know the success stories of implementation and application of business intelligence and business analytics? If you know, please write me one or 2 sentences. If you do not know, so please do not write. And part 2, second part, will be dedicated to the strategic goals map and balance scorecard. And your task will be to describe the opinion of Gary Cookins about the role of strategic goals map and balance scorecard. Again, 1 or 2 sentences will be enough. And please describe your opinion. Is it important for an enterprise to have strategic goals map and balance scorecard, and why? 1 or 2 sentences. Please work individually, and please attach your files with your answers in project. In project, I created the project. Now I turn on this video on my computer, and you also watch with me, or you may use your facilities in order to watch this video as you want, but do not forget to attach this task. in LMS you can find this lecture, these presentations, or this presentation, then feedback task. So this feedback task you can see in the project, also in the separate file. And now I can send you the link on the video in the chat, you know, that you can use it. Okay, I'm going to turn on the video. Thank you for being here. If you have any questions, please write me in the chat by email. And see you on the tutorials. And on tutorials, we are starting use these quantitative methods. We will train these methods. And have a good day, have a good rest. See you next time. So I tried to upload this video. It takes some time. Sorry, but it's too. It took too long time. It takes too long time to upload in my facility, so maybe it would be better to listen to your using your computers. So if you want, you may use your gadgets, your computers, in order to listen to this speech, and I continue trying to upload.
Usually only impact the future. So we drop a product line, we add a new customer segment. What will be the financial results? And we'll talk about the then what in a few minutes. So what I'm going to talk about is I'm going to clarify the confusion and lack of consensus about what is this enterprise performance management. It's typically perceived far too narrowly as a CFO initiative with a bunch of dashboards. It's much broader. Similarly, I'll try to clarify what's this business analytics. Then I'm going to basically talk about the 8 pressures that have caused interest in performance management, because in a few minutes you're going to discover enterprise performance management is not a new thing people have to learn. These methods have been around for decades, arguably some even before computers, so why is there interest in it? And at the end, I'll bring it all together. So let's get going. Put on your seatbelts. I'm going to talk fairly quickly. I think this cartoon sets the stage for the entire talk. Drowning in data, but starving for information. You have this clerk, frowning, sad, shoulders hunched, paper all around. The supervisor at the left in the doorway is saying, "It looks like you have all the data. What is the holdup? I gave you the request this morning. Why don't you have the answer?" And there's so much information, but how do we basically make sense out of it? So I said there's confusion and lack of consensus about enterprise performance management. Is it human resources? If you Google just performance management, The majority of the hits will be HR, employee appraisals, that kind of stuff. The problem is we didn't put the enterprise, the corporate performance management, that adjective in front of it, because this is really about the enterprise as a whole, not the individual, although they certainly contribute. Is it about scorecards, dashboards, key performance indicators and measures, as well as aligning the employees with the strategy? And that's the whole balanced scorecard strategy map from Kaplan and Norton. We'll talk briefly about that, but that's just a subset. Is it about process, productivity, and quality improvement? Yes, but that's business process management. Processes are these end-to-end activities. We're talking about the broader umbrella. So this is the area of Six Sigma and lean management, but it's not the total answer. Is it all the above? And the answer is yes, it's all the above and even more. The good news is this. Enterprise performance management is not a new method or process or system that people have to learn, but rather it's the integration of existing methods most managers and employees are already familiar with, and in some cases they're actually doing them inside their own company. The problem is most of these organizations implement these in isolation of each other. It's as if the one project team's in one building and another team's in another. They're like in parallel universes. You get a lot more power and integration when you integrate them like gears in a machine, where each gear is like one of these methods. And even more power when you spice them or embed in each of them analytics of all flavors, which we'll talk about a couple of examples. Because I believe I'll provide the PDF to Mahmoud, you'll be able to get these slides. This is the definition that I just described. But I want to add that I said it's especially about predictive analytics, and it's all about decision making. Make no mistake, this is about better decision making. So let's talk about business analytics. What is it all about? Well, there is confusion and lack of consensus about what business analytics is. Is it a data warehouse? Is it data mining with query and reporting, the ability to drill down to a purchase order or an invoice to a line item? Is it about business intelligence with enhancements? And I'm going to basically contrast business intelligence with business analytics. They're not the same thing. Business analytics is a step above business intelligence. Is it the technology of data governance, data management, data quality? Yes, but that's kind of the IT shop, the men and women in the glass house that are running the big servers. It's about probabilities and statistics like regression and correlation analysis, or forecasting and optimization equations. And I can share with all of the students in the back, I have some older people here in front of me that they took these courses in college and they said to themselves, I just want a passing grade and be out of here, right? Well, the good news is you don't have to learn this stuff anymore, but the important news is you want to have those capability and skill sets in an organization, because those analytic people are going to be able to make a competitive advantage for an organization. So it's probably all of the above. So rather than provide a definition of business analytics, and I could go to Wikipedia and stick it on the PowerPoint, or go to Tom Davenport and Jeannie Harris's book. That's Competing on Analytics. That was sort of the breakthrough book. My belief is the way you want to look at this is work backwards with the end in mind, know what problem or opportunity there might be, and see if you can apply analytics to it. Regardless how analytics should be defined, there should be no argument as to what is its purpose. And it's real simple. It's about better decisions and better actions on those decisions. Analytics goals should be to gain insights and foresight and solve problems, to make better and quicker decisions with more accurate and fact-based data, and to take actions. So I lied to you. That's probably a pretty good definition, even though I said I wouldn't give you one. Let's contrast business intelligence from business analytics. Business intelligence reporting consumes stored information. Increasingly, BI, its acronym, is being marginalized as reporting. What business analytics does is it produces new information from the stored information. And what these enterprise performance management methods do is they will deploy different types of analytics for the different type of problem that they're to pursue. And I'll give a couple of examples during the talk. Insights and actions. Queries simply answer questions. But what business analytics does is it creates questions. Further analytics then stimulate more questions, more complex questions, and more interesting questions. And most importantly, business analytics also has the power to answer the questions. And I'm going to get serious here, although probably some of you are saying, you really sound like you're serious, but let me just say that in my last 40 years, I think the best leaders and executives had the best answers. Today, I don't think that's the case. I think the best leaders and the best executives have the best questions. There is way too much complexity and volatility and uncertainty in this age with globalization for these executives who are promoted to the top based on their wisdom or gut feel or intuition or politics to pull it off. They have to create a culture for investigation and discovery and tolerance for making mistakes. They just aren't going to be able to make it on, oh, I'm so smart. So, I said that these enterprise performance management methods are not new. Some of them have been around for decades, arguably before computers. So why is there so much interest in this topic? What I want to do is briefly go through these 8 pressures or forces that have caused the interest, and then I will drill into 4 of them in a little more detail. The first one is executives' frustration with strategy failure. Executives are quite good at formulating strategy, or they'll bring in a high-end consulting firm like McKinsey or Booz Allen. Their big frustration is failure to successfully execute the strategy. And there's a fair amount of empirical evidence of this. The turnover rate, involuntary turnover rate of CEOs is setting all-time records. Board of directors post-Enron are not basically in a ceremonial role where you show up and get your $1,000. They're taking governance quite seriously. And examples like Carly Fiorina, and not the thing about Republican versus Democrat, but she didn't basically execute the strategy and HP pulled the plug on her. Second, increased accountability. Today and in your lives, there will be no place to hide for employees. Everyone will be monitored. It doesn't mean that their jobs are at risk, but it means that their promotability, perhaps salary increases, will be jeopardized. 3, more rapid decision making. Unlike 5 or 10 years ago, you could test and learn, sit in conference rooms with your supervisor. Today, employees will be on the phone, go or no go, yes or no. It's real-time decision making. And those employees wish that the executive was sitting in that chair so they would know what would they basically do. But if they have the strategy communicated to them in a way they can understand it, they'll make the right decision. And we'll talk about strategy maps in a minute. 4, mistrust of the management accounting system for transparency and accuracy. This may surprise you, but many managers in a company, line managers, do not trust the accounting system. They think it's flawed and misleading. It may reconcile in total, but not in the parts. We'll talk about how activity-based costing resolves that. 5, poor customer value management. I really believe that what's happening today is customers view all suppliers as a commodity. They view banks as all having the same kind of deposits, same kind of services. Therefore, for suppliers to really compete, they need to provide differentiated services to different types of customers. They're all not doing it well. When we get to that section, which I will drill into, we'll talk about how the CFO can support marketing and sales. 6, contentious budgeting. Poor resource capacity planning. I'm probably going to shock some of you in the room, maybe all of you. I think the budgeting process is so broken. It is such a disaster. It's out of date in a couple of months after 6 months of preparing it, and has all these problems of managers who pad the budget. And I think the best solution is just destroy it, abandon it, just stop budgeting. But then you have to ask the question, what was the purpose of a budget in the first place, and then can we replace what its purpose was? And we'll talk about that in a few minutes. Dysfunctional supply chain management. I'll be quick on this because many of you won't get into supply chain management. The problem there is most customers do not trust their suppliers. In fact, they view their suppliers as enemies. They pound on their suppliers. That's got to stop. They have to basically work together and collaborate because you've got supply chains competing against other supply chains for share of wallet or purse. And there are huge opportunities between the interface between trading partners, especially in the distribution and channel, area. And so they need to find mutually beneficial projects and initiatives where they can save each other money. And the 8th one, which is probably the most interesting, the 8th, 4th, is unfulfilled return on investment promises from large IT systems or lack of integration. And the observation I'll make here is, if you ask a CIO that 3 years later, after they put in a large ERP system from like SAP, Oracle, IBM, Infor, JD Edwards, and I'm not taking cheap shots at these vendors, you know, did you get the ROI that that software salesman told you you would 3 years earlier? After all that work, many of you would say, I don't think so. That does not mean they should not have gone ahead and put that ERP system. They do have to do it. The problem is the ROI is buried in that data like seeds in the ground. And what these enterprise performance management methods, which I'm going to start to describe, does is it releases the ROI and makes it profitable. So here are the four I'm going to drill down. I'm going to keep my eye on the clock, being a good industrial engineer. You know, the trains run on time. Let's start with that first force: failure by executives to execute their well-formulated strategy. And the solution that addresses this is the strategy map and the balanced scorecard. And you can see that they're coupled here. And this comes from Kaplan and Norton. But above that is really something probably more important. It's the vision and mission statement, and that must come from the executives. In my mind, the executives have two jobs: hire and grow good employees, like many of you when you get into jobs, and basically set direction. Set direction. They need to answer the question, where do we want to go? But what the performance management methods answer is a different question. How will we get there? What are the projects? What are the initiatives? What are the processes we need to improve? Now, the Balanced Scorecard, the first book by Kaplan and Norton, is over 10 years old, and many organizations allegedly claim they have a balanced scorecard. I'm not sure there's consensus of what it is, but what surprises me is very few organizations have a strategy map, and I believe that the strategy map is 10 times more important than the balanced scorecard. The balanced scorecard is just a feedback mechanism. The real intelligence and the GPS is in the strategy map. Strategy map and scorecard, they're mechanical. They help realize the vision and mission. They're one of those gears that I describe, a really important gear with a lot of torque. Now, this is not a 4-hour training session, but real quickly, this is a fictitious picture of a strategy map. What Kaplan and Norton recognized is that executives were overreacting to financial results at the end of the period. They said, you need to shift your attention to non-financial information collected during the period and react to it. And they created 4 perspectives that have cause and effect relationships from bottom to top. And at the lowest level is the learning and growth and innovation. This is the soft part where the employees are. And so if the employees are accomplishing those objectives, they'll contribute to the internal process improvement objectives. And if they're accomplishing those, they'll contribute to the customer satisfaction and loyalty objectives. So this is like a force field in physics where you're aligning the behavior and priorities of the employees, kind of like vector analysis if you've had a little engineering, you know, kind of like the crew in the Olympics all rowing in the right direction but in 3 dimensions. And all of those arrows, think of those as KPIs or measures, only 2 to 3 per KPI. You don't have to have a lot. You can't have hundreds of measures. You can have hundreds of measures, but they all can't be a K, okay? So to summarize, a learning environment will stimulate process excellence. Process excellence will lead to customer intimacy. That customer intimacy will then create the financial value. Let's move to another force. Mistrust of the management accounting system and its flawed cost allocations and misleading cost reporting of outputs, products, standard service lines, channels, customers, and outcomes. And occasionally someone in the audience will say, I think there's a typo there. You've got cost allocations. You meant misallocations because it's being misallocated. I'm being charged by the accountants for this thing. I got nothing to do with it, but those 2 departments over there are causing all of it. But the accountants are allocating it on some factor like labor input hours that's got nothing to do with me. So that really has started what led to Kaplan's interest in activity-based costing. And part of it was because indirect expenses was beginning and is continuing to be much larger relative to direct expenses. And this is because companies have so much diversity and variation of outputs, colors, sizes, ranges.
Dear all, we are finishing. So good luck, have a good rest. If you have any questions, please write me in the chat in via email. If you have some time, some free time later, please watch this video, this whole video, because it's very interesting. And please pay attention to his books. He presented his books in first, the first minutes of this video. Thank you very much, and bye bye. Goodbye. Goodbye. And I'd like to tell you that all the records with the lectures and seminars I will put in LMS, and I'll write you about it later.